All right. We're live here. All right, there we go. We got the old mic up. Good morning, everybody. Today is Monday, November 3rd. Elections coming up tomorrow. I'm happy because I can stop hearing about elections. But we're not here to talk about that today. We're here to talk about earnings and the brand new SpotGamma calculator. We launched this last week, was the open house. If you participated in that open house, I understand you're very excited about the calculator. If you didn't participate in the open house, you feel like you missed out and you should feel like you missed out. But the good news is we have a lot of amazing deals coming up if you want to join us and join the calculator. And you can do so at spotgamma.com/hidden forces. Whoosh, looks like this. You can join here. We got a pretty sweet deal right now. And the reason it's a great deal is because there's a lot of fun stuff to trade at the moment. And so we're going to jump into that. Now, if you're a SpotGamma subscriber, number one, thank you for being a SpotGamma subscriber. Number two, I will see you at 1 p.m. today. We have a fall on and we have, man, we got the elections. Rates are moving. Is there like a war now with Venezuela or something? Let's hope that's not true. There's like still all these wars all over the place, which is just gross. I'm tired of war. And then the third one, what was the other one? Did Trump Z thing work out or not? We got the government shutdown. Elections are, it's like everything, right? It's crazy. So before we get into the election stuff, I just wanted to make sure everyone was aware of what's happening this morning. Number one, there's giant red negative gamma all across our map. We talked about this in the founder's note. If you are a SpotGamma subscriber, you know what I'm talking about because we highlighted this area, 6,800, 6,925. And it was kind of like, look, man, unfortunately, we're in no man's land. We had to push down to an area where there's big support or big resistance, right? And so you look at Trace updates every 10 minutes, the map with how we see the buy side positioned and how the dealers have to hedge that. So negative gamma means dealers are short calls or short puts, and it's pretty big negative gamma. And there's not really great support into this. Maybe you get into 68.25, 68.30, then we start to see some, what I would say is local positive gamma, meaning it's short dated flow. So if I toggle this on and off, you can see that the map doesn't change much. So there's a lot of, mixed zero DT support in this general area. So maybe we get a bounce there. This purple line is HIRO. HIRO is the hedging pressure, meaning everyone comes in, they start selling puts, selling calls and buying puts. That means negative deltas for the dealers to hedge. So these are the targets. And then what is the flow doing? Which way are we pushing towards? And ultimately, that's what we're watching. This purple line stops going down at support, which is this blue area right now. Then that's a great sign that we could bounce off that level. If we zoom way out, way out, what you see is around the 6,700 level, this map gets much more blue. So if we do plunge into the 6,700 area, I'm going to feel better about buying that dip, sort of putting some, the old retirement fund back in the market or whatever it may be. Let that money work for a little bit, right? That's not necessarily the short term, immediate bounce area, but it's just kind of like, okay, market supported. Now maybe that's the good slingshot sort of zone for year end, right? So that is a short-term dynamic, but we're not here to dig more in on that. If you are interested, join us spotgamma.com/hidden forces. And then we will talk about it at 1 p.m. with our subscribers. Thank you, subscribers. All right, we're going to talk about earnings. We did a video and a little webinar last week on Google earnings. And so what we're going to do is we're going to break down how the SpotGamma ecosystem here can help you to evaluate earnings. Now I'm going to talk about Palantir because that's a big one. HIMS. I'm trying to avoid making any inappropriate jokes when I'm talking about HIMS, so apologies ahead of time if I do so. And then what's the last one? AMD. That's right. Well, how can we figure it out? So if we go to the overview page, and by the way, the earnings chart is actually available for free at spotgamma.com. There's a little link up there. You can go to free tools, but we're in our old dashboard. So what's reporting today? What's good? HIMS and Palantir is tonight. I'm going to focus on those two because they are right here, right now. What you see with Palantir is it is a 8% implied move. That's pretty hefty. And then what about HIMS? HIMS is a 12% implied move. Okay, those are pretty big moves. What I'm going to be looking for here is there a feature of the volatility surface that I think I can exploit with an options trade? Now, usually with an options earnings trade, it is that vol is too high. Maybe things are too skewed to the call side or put side. Occasionally, it is that things are too cheap. Occasionally. So what we can do here when we're looking at positions, we can figure out, number one, what are the support and resistance levels? How wide is that implied move off of those gamma derived levels? And then number 2, can we exploit something from the vol surface? So let's go check that out. We know now 12% move for HIMS, Palantir, 8% implied move. So, okay, that's our base case. Now, let's go to our scanners tool and just get a high-level overview of how cheap or rich options are from a 1-month option. Our compass tool now features this trail. The trail is brand new, part of our launch here for October, and it shows you the move in these assets in terms of rich calls, which are on the right side of this chart, and then on the left is rich puts. Henry, what's up, man? Good to see you. We're going to be on with simpler trading, I think, tomorrow. So if you're in the simpler trading community, and John R., what's up, man? Good to see you as well. All right. So what do you see here? We talked a lot about QQQ and spiders had really rich calls, and now they're moving to the left, right? Those calls are burning off. And the market's been pretty weak the last few days. And we went from extremely rich call chases. Then the banks put out all of this research saying the call chase is inevitable. And you go, no smart person is going to keep buying calls when the IV rank is, or the risk reversal rank, excuse me, is 100. That would just be kind of dumb, right? That means you're paying objectively, statistically extreme prices for those calls. In fact, what do you generally want to do with a call that you feel is extremely rich? I'm not talking about like mildly rich. I'm talking about like extremes, right? Highest rank that we've seen in the last year. You probably want to sell that. And what's funny about this on X is they were taking systematic call sellers to the woodshed. And we wrote about this on Twitter, and it was like, well, generally I agree that systematic call selling is pretty dumb. Although right now, call selling probably makes sense. Anyways, it's just funny how that works out. All right. But we're here to talk about 2 specific stocks. Number 1, HIMS. Add HIMS. Boom. There's HIMS. Ooh, look at that. I'm going to hide silver. So HIMS. On the right side of our chart here, what is that telling you? Number 1, risk reversal rank of 91 means that only 9% of other times in the last year has calls been more rich than puts than there. So people are pretty bulled up on HIMS, right? So let's just take a look at that chart and see what that looks like so we can get a little bit of a background. Remember, it's a 12% implied move. So when you zoom out on this, what's interesting to me, and I'm looking at this in real time. I didn't pre-prep this. I don't want anything else in my mind. What happens in this market is when stocks sell off, people have been buying calls because they assume that everything bounces. We're just in that. That is our meme. That is the meme, right? The era that we're in. Buy the dip, right? So that's the case with HIMS. And then number 2 is Palantir. Palantir, much less bulled up right now. And that's also interesting because the stock never really got that bulled up, as you can see with the 3-day snail trail right here. Let's make this 10 days. It was actually pretty low. So even though we had like Google, SMH, all this stuff on the bottom right of our quadrant here, suggesting that calls got really rich, Palantir never really participated in that. Now Palantir's had an incredible year in terms of price action, so maybe people are like, well, it already got bid up. I don't really know, but HIMS, this is the big retail thing. All right, I'm gonna make jokes. I gotta stop making jokes. Pause, Brent. We're streaming here. All right, so Palantir, pretty average in terms of the call versus put ranking, and HIMS is pretty rich, statistically rich. Okay, now step 3. We found the earnings. We know what the implied moves are. We know that the calls are pretty rich in HIMS. Palantir overall, in the implied vol overall, in other words, how high or low are we on this ranking here, is the IV rank. So you could have rich calls and extraordinarily high implied vols. We don't see that right now with anything, but when you're talking about a name that is rallying and calls are getting bid up, these are fairly rich implied vols, and that makes sense going into earnings. Okay, what about ranges? So let's look up Palantir first, and what we generally like to do, and what I'm gonna shortcut here. I'm gonna go to our total OI model. So we have 2 models here. Number 1 is our synthetic open interest model. This looks at how funds are positioned and how dealers have to hedge that flow. So if you look at Palantir, what do we see here? We see this giant strike, the 210 strike. That's a big level in Palantir. Stock's trading at 203. And this is a strike that the dealers are long. They have positive game, which means if the stock jumps, we should see selling or some kind of pinning flow into that area, right? Other than that, it's pretty quiet in Palantir. So I'm going to look at our total OI model. And the reason I like to look at this is because this gives me the effective range. So if you look at all of the positions, open interest in Palantir, you say, what is the high and low? What is the most we could really see move here? And what you'll see is that this is the gamma the gamma curves, right, off of all open interest. And so you say, in the most extreme scenario, where would dealer hedging flow or any type of hedging flow sort of wane, right, off of an extreme move? And when we look at this, you can see there's a lot of positions all the way down at 260, and then all the way down here at 150, and then under that, you can see those positions really disappear, right? So it's kind of 160. That's a pretty big range to the downside because the stock's at 200. So that's a 20% down. That's a lot. And then to the upside, we mentioned 210, and you see there's a ton of open interest there. And then over that, maybe into 220, but these gamma curves really flatten out, certainly over 220. So this feels like a very wide range of probability or possibilities here based on sort of the maximum influence of hedging flows. Now, the earnings could be benign, it's no big deal, but what we've seen in the past is when you get like this feels like a very big spread, right? And so when you're kind of like just, I like to draw on this chart, a big price chart, because it sort of puts things into context. So you say, okay, well, you got plenty of room, certainly up into 210, right? Which is, let me zoom in on this a little bit. Stock has moved so much. So certainly into 210, which is only about a 3% move, and then maybe up into 220. So that's about an 8% move. I will tell you, so many times we go and we look at these ranges and we go, okay, what is the implied move on the day? And then it matches up with where this big open interest is. It's funny how that works, right? Okay, so there's your upside, about 220. And so this is kind of the high end of where I think the stock will go. And then the downside, you look at it and you go, there's a lot of slippery downside here based on all of these positions, right? All of these positions, certainly through 175, there's a ton of open interest. And then, where would the move exhaust itself? So when I'm thinking about this, I want to make sure that I'm playing the implied vol crush if that's what we're going to do here, but I also don't really want to be short the stock, right, in a way that's going to expose me to a lot of movement. In other words, I don't want to sit here and sell the bejesus out of 200 puts, right, if I think that the stock has the potential to move a lot lower than that, and I'm not making a lot on the implied vol crush, right? So that's the effective move that we see there for Palantir. So, all right, so that's pretty interesting. And then let's just take a quick look at HIMS. So we have our ranges. I'll leave that up. That's the effective range. I'll bring up another trading view screen here. And then when we look at the ranges here for HIMS, you can see there's a ton of puts. Dealers are short puts. This is our total OI model. So there's a lot of put positions. This is not with the dealer's positions. This is just all the puts all the way down to 30. And then you kind of got a lot of kind of calls spread out into even all the way up into the 70s. Now, remember, it's a 12% implied move here. So if we just do the same thing to get a snapshot of this, and you go, okay, like, look, that's interesting, right? Positions all the way up into previous highs, basically, kind of in the 70 area. So it's like a 50% move. That seems like a lot. I don't know about that. And then kind of all the way down again into this 30 area is the same thing, right? Right here is this giant put position. Under that, there's hardly any positions. So if you think about this in another way, you're like, hey, there's 13,000 hedge funds. There's millions of retail traders. There's all these people, and no one really cares about owning puts below 30 in HIMS. Probably that's a fair value for a downside, unless there's some sort of fraud or something that happens, right? So, but the bottom line is that this looks like a 30% kind of like maximum range, and it's a 12% implied move. So this kind of feels like, number one, the calls are quite rich, obviously, because statistically you've shown that. And then, if you look at the put side on both of these names, you're like, well, I don't know if I want that downside exposure, right? So let's look at the vol surface here. And what I'm going to do is I want to show one of the tools that we don't look at enough here at SpotGamma, because I think it's one of the best. I'm starting off with HIMS because we were just looking at that. I'm going to show you our skew premium. Now, what is skew premium? This shows you which options have the fattest premium into an event, right? Or even not into an event, just generally. And what do you notice about this? There's no teal color here anywhere on this chart except for all of these calls, right? So if you look at over the next, call it month, you see these are the options that have the fattest skew premium. I already told you that statistically, the 1 month calls are very rich relative to the puts. So this is the fattest premium, and you can see there's 50 cents of premium in these 1121s. These are the very liquid November expirations, about 2 weeks out. So I'm going to focus on looking at possibly selling some type of strategy for this extreme upside, right? If this is the fattest premium. Arguably, selling puts in this environment have a lot less premium, right? And you would need a pretty big miss and a big down move in order to try to extract some kind of premium from earnings straight from there, right? So that's interesting. That's where the fattest premium is. Now, if I look at this in Palantir, what do we get? It's actually the opposite. The put side seems to have the fattest premium here, and it's not, it's not a ton on this $200 stock. You're getting, look, 50 or 60 cents of skew premium in these downside strikes. Whereas remember, HIMS is a $50 stock, and you're getting about the same, right? 20, 30. Up here, you're getting, 45, 50 cents of premium. So you see the difference here. And when you're trying to line up your earnings trades, knowing where that premium is fattest is also, quite useful. All right, now we're going to move to the payload, the options calculator. Now, many of you have traded options in earnings, and hey, Brent, and I was talking about someone about this on Twitter. Oh, really original thought to think that implied vol crushes into earnings, right? 90% of the time or whatever as a general guideline does. But here's the problem. You don't always know which side it has the most skew. I've just showed you how to figure that out, right? Also, how do you estimate exactly how much the implied vol surface is going to change, not just for an implied vol change, but when skew changes? Now, to my knowledge, we are the only calculator that allows you to do both. I've seen other calculators. There's different ones out there, different option strategy tools out there that just don't do this. And oftentimes that's because what happens is you have a tech guy who's a good tech guy who makes a tool for you, and then you come out and use it, and they're not actually paired with people that are options experts. Now, in my case, I am not a tech programming expert, but I have myself, and then we have people like Sherry and JT in our community. They use these tools, they figure them out, they go, this is great, this works. And then we have some excellent engineers that code this stuff up. So we're trying to marry both of those things. Now, why does that matter? I'm going to show you some HIMS trades now. So here's HIMS. We can add in a bunch of different features on here. So we talked about the call skew being where the premium was. Seems like that 70, 65 recent all-time high number also was elevated. But the second one is the reason that the skew premium seems elevated is because people are trying to position arguably to buy the dip. Now, if you have a 90% statistically elevated skews, which we just showed you, that seems like where I can attempt to go and get some premium, extract some premium, right? Not because I have any idea what HIMS is going to report. I don't, nor do I really care, but I know that people are kind of over their skis a little bit in terms of those call premiums. Now, our key levels we can add onto this chart if we want. There's your call wall at 60. That's the strike that has the most call gamma in the total OI model. So that's a good strike to lean against. Stock is currently trading at 45. So what is generally a good starting point for an option that you want to sell? I generally like looking at a 25 delta option. And I also mentioned that the 1121 options are the most liquid. Obviously, that's a monthly expiration. So there's a 10-day out option and there's an 1121 option. Now I'm looking at this and I'm thinking, how do I know which one to choose? How do I know which expiration to choose? I'll show you a cheat. If we go to our volatility dashboard and we go to the term structure and we say, this is the current term structure for HIMS. How much do I think vol should change around earnings? I need a base case. Well, all I do is I go in here and I add forward implied vol. And look at this. I can see that for the 1114, our model estimates that we would see implied vol go from 122 down to 81. That's like a 40-point vol collapse. That's pretty big. What about the 1121? It's a much smaller relative vol change there. See that? We go from 113 to 96. So, okay. So that's still a big vol drop, right? That's like a 20-point vol drop versus a potential 40-point vol drop. So those two expirations seem like the chunkiest. You can see that that premium shrinks out in time, which is the way that it normally works. Okay, that's interesting. So I'm going to go back to the calculator. I'm going to choose either 1121 or 1114 expiration. In this example, I'm going to go with 1121. Simply because that's the most liquid option. And in the case of speculating on trades here, I want to give myself a little bit more time. What's a good starting point for a call you want to sell? Well, the 25 delta, all else equal, is a good starting point to evaluate this stuff. So what we've done in our calculator, and you won't find this in other calculators, I do not believe. If you scroll down here, you can see the delta call, right? I'm giving you the delta of the call. So 56 is the 25 delta call. That's interesting because I have the call up at 60. I know that that premium's pretty rich. I'm going to go with the 55 just because I think that round strike will be even a little bit more liquid. So we're going to round to that. So that's roughly the 25 delta call. That option has 116% implied vol. It's trading for $1.73. And you can see the delta there. As I mentioned before, it's about 25 delta. And the theta is here. It's 11. Now, this is what a normal calculator would show you in terms of your P&L. And with the stock at $44, which is way down here, you can see that I pay $1.73 for this if I was going to buy it. And over 55, you have to really get over 56 for me to start making money. So I would need a pretty big move. But as we said before, what we really want to do is, Brent, is we want to sell this thing. So I'm going to click this and I'll just, there we go. Now we're shorting it. So my maximum P&L now, if we go to expiration, I can make the maximum of $170. We've all seen a chart like this. It's cool. Like ours is pretty, but where's the rubber meet the road? Let's shorten the expiration. If I'm shorting vol for earnings, then I'm going to hold this thing for probably a couple of days, right? So let's make it a one-day trade. Now the P&L is getting a little more interesting, right? Now I can see a little bit more what's happening. I'll turn these levels off. What the market implied vol is telling me is if HIMS drops in price, I will start to make money. You can see the green to the left. And if HIMS rallies, I'm going to start to lose money. Now, this does not shift implied vol at all. And you go, hey, Brent, there's a couple calculators out there that allow me to shift vol. Well, how much should you shift implied vol? Do you know? Do you have any guidelines from stats? Any evidence at all? I've given you a bunch of stats here already today, but I'm guessing that other systems you use or other calculators you use or free ones, God forbid, they're not going to show you any of this. But what is the next level to this? We click IV settings. What are we looking at now? We're looking at 1121 skew. This teal line is the skew for the 1121 expiration. Remember how we were talking about how rich calls were? Now you see that in the calculator right here. See this? The at the monies, kind of this 40 area, are elevated, but not all that elevated, right? Based on the statistical cone. That cone is the last 90 days. And if we rally, you can see that the skew is up at the top of this 90-day curve. This backs the idea that the 1 month options have a 90th percentile skew, and this is the area that I want to try to mine. Now, what happens if HIMS comes out and says, hey, earnings are fine? Great. Implied vol declines. And remember before, for 11/20 expiration, we were saying should be a roughly 30-point vol decline. Now that will take a couple of days maybe to come down. So let's just say we're going to lose 15 vol points as a base case. So I hit minus 15. Now what do you see? The red line is now 15 vol points on a parallel shift, right? I've declined vol 15 points. But what have we also said is the big feature of this current situation? The call skews are also quite fat, right? Now, in this market where people chase the you know what out of calls, or if we crash, like we are working lower right now, then what happens? The skew gets richer or steepens or flattens. So what happens now when I move this call skew up and down? Watch this line change. It just totally flattened out, right? What if everyone's like, HIMS just came up with new pills that make you handsomer, more handsome, and the call skew goes bananas, right? So this is what call skew currently looks like, 0. That's call skew. I think that HIMS comes out and says, we're doing good, we're doing fine. No new pill for everybody, just kind of status quo here, and that skew flattens out, right? So what happens if I flatten skew out? Now you see this red line decline, right? Which means that all of those calls that have the fattest premium, if that is true, and statistically we know they're rich, there's no guarantees in trading, but I'm going to go against the stats every time, right? Or go with the stats, right? If you tell me that's a 90th percentile, statistically, I believe it has to come down. So I'm going to play that, right, as the feature I'm trying to exploit, the rich call skew. And if your calculator can't adjust the call skew, then you're not adjusting implied vols the right way. And then not only that, how do you know how much you're supposed to adjust? You have to really know the vol surface for each individual name by yourself, or you have to come in here and get the stats from us. And we're just using the stats here, right? And so that is the differentiator. This is the difference, I believe, when you adjust these skews, the difference between being a consistently successful trader and one that like has some good trades and then has some bad trades, and then you blow up and you get disinterested and you just spent a bunch of money on transaction costs and it just kind of all sucks, right? But if you can adjust this stuff more appropriately, I believe that you will get that extra edge in a meaningful way. All right, so we flatten call skews out. Now, the skews are flattened. I hit save. Now, what do we got? Scroll up here and I can move my chart around. Now you're see is there's new lines on your chart. Up here, move my face down so you can see this a little bit better. All right. Where should I put myself that I'm not in the way? There we go. Made myself tiny little Brent over here. Tiny little Brent will sit right there. Now, up here is what happens if you hold this trade to expiration. if you hold it to expiration in the next 17 days, you will make money as long as the stock doesn't go for 55. That is the, that is toy model thinking. More importantly, look what happens here. You have two lines on your chart. The purple line is our IV adjusted P&L. What does that mean? We built a custom skew in here. That is using our custom skew to project P&L. The dashed line is what happens if you don't adjust implied vol at all. So what does that mean? That means if the stock opens tomorrow unchanged, essentially, we're at 44 right now. So the stock essentially opens unchanged. We will make, in our estimate with our model adjustments, $52, right? Whereas if you just use the market implied vols, that's the current implied vols, you would lose $3. So that is the difference, $50 of difference between the making money and losing money, right? And not only that, because we're flattening the skew out so much, we're understanding the P&L of the entire trade all that much better. And what's fascinating about this then is that the skew adjustment really allows us to better understand where we're going to make or lose money. And so if I just push this out a day or two in time, what you see here is that this is now the projection of the P&L that is arguably a lot more accurate for a 25 delta option. Now, what you can then do from this is that you can extend on this, right? You can turn this into a call calendar spread, for example, to make a more sophisticated trade. You could turn this into a call fly, for example. So if we set up a call fly real quick, this is now the 12/5 expiration. So we can just change this if we'd like. Let's change all of these to 11/14 just for fun. This is what this looks like. Remember, I want to position around the call wall. So how can I do that? Let's do it really quickly just to give an example. I want to make money as long as we're under $55. So I'm going to do a broken wing call fly. So there's the 50. I remember the fatter premium was up here. Okay, that's interesting. Remember, we only want to hold this thing for a couple of days. This is what that P&L looks like. Remember, I haven't adjusted the skew curve at all. So right now I make a little bit of money, 14, 15 bucks is what the market tells me. If we hold the expiration, our max P&L is if we stay under this 55 level, and I make money as long as we're under 60. So that's the base case for this call fly. But I have to adjust these implied vols again, right? So this is going to be for 11/14. Remember, I went very short. Remember, there was a 30-point vol drop for there. So let's say you get a 20-point vol drop. That skew is going to flatten out again. Now, if the skew's flattening out, that's better for me when I'm short these 22s. Now, this is a tremendously wide spread, but I'm short these 55s and I'm long the 50. And so now what we see, if we zoom in on this, now what we see is that I'm going to make money as long as the stock is under really all the way up into that mid 50 area. See that I have negative P&L only we can do that into that mid 50s area. So is this one, as I do this on the fly here, is this particular example, the grand slam home run? No, but look what happens, right? I'm going to be making money because that call skew flattens out. Then I should make money all the way up in this low 50 area. So when you're adjusting these skews, you can figure out how to mine or extract or exploit the premium that you most want to, the feature of the surface that you most want to sort of attack, right? And so that is also the real payload of what you're trying to do here. So again, in HIMS, what I'm trying to do and what I want to structure and what you play with is come into the calculator here, look at these call scenarios, right? Where you're trying to be short, not naked short, but you want to mine this skew premium, which appears in this 50 to 55 area. And again, I don't want to have a whole lot of short exposure to the stock while we're under 60. I'm willing to take some short exposure to the stock, meaning if the stock really goes up to 65 or 70, okay, I may lose a little bit of money, but based on that giant call wall and all those positions above, I think that's where we generally hold. And that may sound like an interesting or new idea, right? But if you go to the market overview page and you're part of the SpotGamma community, I believe we posted the Google chart in here. We did a webinar on Google and we said, look, 290 to 300 is the area of resistance. Stock goes up to 290 or 300 and then just totally cools off from that level. So these gamma levels can really help you understand your maximum move, right? And that's so important when you're trying to do these volatility trades. Now, let's just say, for an example, that we wanted to look at Palantir in the same way. Now, when we looked at Palantir, the overall, and I'll just refresh you on this, Palantir overall was not terribly interesting in terms of, you can see it right here, right? It's kind of got average IV rank, risk reversal rank, not all interesting. And the skew premium that was fattest was those strikes to the downside. So what can be interesting in this situation is you say there's a chance that this stock moves all the way down to 175, right? And the market may not be seeing that. Now, again, I'm not trying to predict that this is what happens, but I just want to give an example of how you would set up a trade in that situation. Because remember, we're looking at the fixed strike matrix here for Palantir. Let's put that back in. And the skew premium that was the fattest was these guys all the way down here at the 160s. So what if I think Palantir could drop a pretty healthy amount, right? And earnings is going to crush regardless. And is there a way that I can make money on both the vol crush and the stock going down if I thought that was the dynamic that would come into play? I think I could. I'm the little engine that could. All right. Put fly. Why is the put fly making sense here? Because I'm going to buy one put, and then I can also sell two at that fat premium area that was, maybe most interesting area to mine, that fatter skew premium. And then if vol collapses like it likely does after earnings, we could have a situation where stock goes down and vol crushes. So what I'm trying to do is get some free or cheap short delta exposure, but not be exposed to long vol, right? That sounds complicated, but the calculator really helps us with that. So as I showed before, we could get all the way down into the 175, 160 area with this type of trade. So I have a put fly lined up. I'm going to go with 1121 expiration. Again, most liquid just for sake of argument. And then I'm going to try to structure this trade in a way that would make money if the stock goes lower, while I'm also going to try to get that skew premium that was evident in these kind of like 160 area trades, right? So I'm going to come down here and I'm going to put something a little decent meat on the bones, the 11, so the 175. So if we refresh these, I'm paying $12 nearly for this one 200 strike puts, $3.50 for these 175s. And then I don't think that the stock could go much under that. So I'm just going to add in something to make sure that I don't, lose my account, right? I don't want to blow myself totally out of the water. So we'll just put on the margin cap, right? So this is a broken wing fly. And again, I'm doing this live. So please do not copy this trade, but copy the process. Work through the process yourself, play with the different trades. So the IV that we talked about with Palantir, and if we go and just look at this, let's just reload this real quick. So we go to the vol dashboard, we know where the premium is the fattest. And if we load in Palantir again, I just want to get a feeling for how much IV could collapse. So we have forward implied vol, and you're talking about for 1120 expiration, 10 vol points maybe. The total spread there is about 15. So let's say 10. I like to undershoot. Obviously, we're not going to probably get more than that vol crush. So there's 10. See that come down. And then you remember the premium difference was fairly small, right? There wasn't, when we're looking at this chart here, on the 1 month time frame, the risk reversal is the difference between the calls and the puts is pretty even. So there's not evidence of an extreme put skew or call skew. But the vol dashboard did show us that the fattest skew premium was down here in the kind of 160s, right? So I'm going to look at flattening out that skew premium. So let's just flatten this out just a little bit, not a ton. It's a subtle measurement, but again, I think that's the difference between making and losing money often with these trades. Second thing is I'm not trying to hold this to expiration necessarily. I'm just trying to hold this to a day or two to see if I can get the earnings reaction premium. So what does this trade now look like? Now, again, I put this together pretty quickly, but look at the dynamics of the P&L that I'm getting. If the stock comes down, right, I paid $5 for this spread. That's a little bit expensive. I generally like to try to get free trades if I can. So we'll play with that in a second. But if the stock goes from where it is now, right around 202, if we get down in this 188 to 175 area, I have positive P&L all the way through 165, which is the maximum. And then under that area, what you see is I could have actually pretty sharp P&L. But I would argue that I'm comfortable with that because I don't see the stock going much lower than that based on the options positions that I see. The market suggests that I would only make about 50 bucks, 60 bucks if we get that big of a reaction, right? Whereas our adjusted P&L shows a couple $100 of P&L into this scenario or into this situation, which is obviously a lot better there's a 200 or 300% difference in that scenario. And then to the upside, what you see is we actually would lose, $100. We pretty much match the current implied balls in that scenario. So as I mentioned before, I don't love the idea of spending so much premium. So if I drop this a little bit, I can move that to $9. How does that change my P&L? You can see you can play with this a little bit. Now it's only $3 for this trade. I make a little bit less in that scenario, but what is nice about this is that when I'm looking at my Greeks here, you can see that I'm a little bit flatter, right? Because two of these options is roughly 24 delta. So I have a mild short delta on. You could adjust those Greeks, play with these strikes to make sure that you're getting the type of exposure that you want. Now, if you love this trade and you go like, well, you know what? Let me check this again closer. I can just come in here and save this position. I would just call this the Palantir ER trade. I could save this. I can reverse it. I can flip it if I want to close it. I could do a whole bunch of interesting things with this. And so that ability to save and play around with this makes a ton of sense. So I know I went through all these examples pretty quickly. I know you're looking at tiny little Brent on this screen here, but all of this below is brand new. The ability to not only adjust the skews, adjust the implied vols, slide your time around, really get a professional look at how your trade is positioned is critical. I believe we are the only calculator. I've used every calculator out there. I've used the Bloombergs. I've used paid ones online. I've used our brokerage platform. I couldn't ever get the skews to adjust the way that I needed them to in order to project trade P&Ls. And so we, again, to my knowledge, are the only one that do this. And if you are so inclined, go to spotgamma.com/hidden forces, and you are getting pretty amazing offers right now. 50% off your first year. That is only good for the next 2 days. So if you join today, we have another webinar at 1 p.m. We have Sharpen Your Skills sessions, which we've just rolled out. We also have a bunch of new tools, which I didn't mention here, but I'll go through them quickly. VIX term structure. This shows you brand new all of the VIX futures versus the VIX index itself. You can compare this versus historical terms to see what that VIX term structure is implying. A lot of interesting moves there. We have the snail trail. I call it the snail trail. I'm not supposed to call it the snail trail. It is the historical trail. This is brand new. It gives you the context to understand how all these names are moving around these ranking sheets. I think just using this and the calculator and adjusting skews alone is just worth the price of admission right there. But that's not all. Wait, there's more. We add a bunch of new scanners. Our community here is always asking for new and different scanners, and we love them for that. And every once in a while, more than every once in a while, we come and say, that is a wonderful idea. Let's do it. And so we've added a bunch of new scanners, including call wall and put wall increases and decreases. And that is extremely powerful. So the ability to sort of top of funnel, generate ideas, drill into those with these volatility tools. These volatility tools are as good as any volatility tools out there. I would put them up against anybody, Bloomberg included. And then, of course, you get Trace, showing us a live market movement. As I said before, this is the area for the bounce. And what just happened? We bounced at that level. Because we're on webinars, I couldn't sling any futures around, but that was the level. We hit it, we bounced. And what is HIRO telling you? It bounced. What about that HIRO thing? Oh, yeah, we upgraded that too. Brand new HIRO, powered by TradingView. What is so cool about the HIRO signal is it shows you exactly what traders are doing. Are they buying and selling puts and calls in the favorite name you're trading? That's critical information to know. And so what you can see here is the S&P equity basket, the sum of NVIDIA, Tesla, Apple, all of those options being traded. If this number is going up, it tells you that people are buying calls and or selling puts. And this is a dollar value. So far they've done $245 million of buying off of these lows that came in here. And then you can add all sorts of funny emojis and stuff on here, which is fun. It's a toy. But the stuff that is not a toy is the ability to add moving averages, volume profiles, all that stuff, all those different types of indicators on these charts. Again, all that is brand new. And we're getting incredible feedback on that. So that will wrap this up. Again, for our subscribers, thank you so much for joining us today. Again, 50% off your first year if you go to spotgamma.com/hidden forces. I know I ripped through these calculator examples, but this is the cool thing. I've seen what other web calculators show, and those toys are priced at, I think, like $50, $60, $70, $80 a month. You can join our standard and you get the founder's notes, you get access to a whole bunch of other indicators for the same price as that, and you're getting a calculator that actually adjusts vols and things like that correctly, which is pretty amazing. If you go for the whole enchilada, which gives you HIRO, Trace, Tape, which is our our data tool for looking at all of the options, positions, all of that is part of Alpha, which is also 50% off. Pretty amazing, right? And our goal here is to make sure that as traders, you are able to monetize the data and the information that you're getting, right? Because if pretty easy in this game to understand if it's worth the price of admission. Well, you're getting 50% off. It's a pretty good place to start. And then obviously you have Palantir earnings, you have HIMS earnings, so you could try out the calculator and that stuff. Then we have pretty interesting movements in this market into year end. Trace already just gave us a trade, right? I'm sure everyone in the Discord community here at SpotGamma was watching this bounce. HIRO bounces. We go right off this level. This is the opening level that we talked about. So pretty easy, hopefully, to generate trade ideas and be more accurate with their trading with everything that we have here at SpotGamma. All right, that was all very long-winded. For our SpotGamma subscribers, we will see you at 1 o'clock today. And if you are new here, please join today. You will get immediate access to the platform, immediate access to join me in our webinar today at 1 p.m. where we'll be going through more trades, more examples. If you have any questions, you can jump on, ask me questions about the platform. If you also have any questions about our offering here, how you can get involved, you can email us info@spotgamma.com, and we're happy to help you out there. And that's going to be interesting. That'll be it. Oh, yeah. There's one other thing. If you are new here, we also have this thing called Flow Patrol. Flow Patrol is based off of our SpotGamma Open Interest, a tool we launched in April, I believe. And we are the only ones, I think even in the bank realm, we're the only ones that show you how the buy sides are positioned in all of these different instruments. And so if we say everybody loves NVIDIA, how are people positioned in NVIDIA? Which you see here is a lot of positive gamma, particularly the 210 strike, which is almost the same strike as Palantir. It's a little weird. People have been selling calls in NVIDIA. That's a normal thing these days. Interesting. But when you look at something like Tesla, selling calls, interesting. What about Google? Short calls up in the 300 strike. This tells me that Google has more potential upside than some of these other names. So you can only get that information from SpotGamma. I don't even think you can go to Goldman. Maybe you are a huge hedge fund guy and you're like, hey, Goldman doesn't have this. And I would say, I think that's right. What about this? This is Flow Patrol. If you are part of the Alpha community, you get this report every day. We tell you what the actual biggest trades are, whether traders bought or sold those positions. If you're on Twitter or X, you get these Flow Bros that put out a sweep order, which is not even necessarily a fund doing something, and they just sort of like go, this is where the trade took place, and so this is what the trade means. Half the time it doesn't mean anything close to what they say it means. And so in Flow Patrol, you are getting the biggest positions. And I will also say that I personally, I'm saying this from first person experience, have found a lot of amazing trades in the unusual options positions, because what we're doing here is we're finding names where there's big buyers or sellers of options that are a little different, right? So I'm looking at this right now, for example, SOC. It's a cheap stock, but somebody went out there and bought $850,000 worth of 750 strike puts. I don't know what that is, but I will go check out SOC after this, because maybe that's a Sharpie, a smart person saying, hey, great, I want to short this thing, right? I don't know anything about that stock, but if I know someone's putting 850 grand of premium into puts, could be a hedge on a big position, could be an outright, bet on something. I'm going to go dig in and see what's going on that specific name. So this tool, again, it's had incredible reception. Thousands of people. It's pretty astonishing the number of people who signed up to receive Flow Patrol during our launch window of that product. And obviously there's thousands of SpotGamma members getting that every day. And so that's it. All right, we're going to wrap that up. We hope, again, you join us here, spotgamma.com/hidden forces. Get your P&Ls right on your options trades, critical. Get Trace, get HIRO, know what's going on in this market. We'll be here to help guide you. SpotGamma.com/hidden forces and SpotGamma subs. Thank you very much for joining us today. And we will see you guys specifically at 1 p.m. All right, take care.